Hello viewers, good morning. So welcome to Nezos Trading Center. So you are all welcome once again. So today we are here to to learn about trading. So you are all welcome. Just feel free and enjoy our trading courses. So my name is Confidence Ajay. I'm the chief trader and trainer at Nezos Trading Center. So today we are trying to look at introduction to forex trading. So within a few years, there were a lot of information or news concerning forex trading, which have started in so many years back, around 1893. But recently, it's an emerging businesses that a lot of people have engaged in. Therefore, it is imperative as we have those information to be able to release that information to other people to be able to also have knowledge about it. This is the purpose, that's why we are here today to give information about forex trading. So we have this program at today 9 and it will be repeated at 1 p.m. today. So if you fail to join this morning, oh, don't worry, you can equally go back to the same link and enjoy the repeat at 1 o'clock p.m. So what then is forex? So forex simply means forex exchange. So it's just the short form of foreign exchange. Now, in forex, we have something we call forex market. That's a place or where the exchange of foreign currencies or exchange of currencies happen. Sometimes people use a short form saying is FS. So now, a decentralized global market where all the world currencies are traded is known as the forex market. Then, who are the traders in that market? So we have the banks, we have the businesses, we have government, we have investors, and we have retail traders like me that is here presenting to you. So we also speculate into the market to be able to make some small pips out of it. So simply when we talk about forex, it's just a foreign exchange. And in foreign exchange, we have a place where the foreign exchange happens, which is the forex market. In short, we call it FX or currency trading, anyone that you want to go by. Then there are so many hours that we we trade in the market. Now, depending on the broker and depending on the type of pairs that you are running or the type of market that you find yourself, a lot of people do not know that we have more forex market. So most only know of the cryptocurrencies where we have the Bitcoin, the Bitcoin, the UTDT, and all those among others. But they don't actually know that we have other forex market where we have the currency pairs. We trade only the currency pairs and the commodities, and we also have the synthetic market where we trade the volatilities. So depending on where you trade depends the hours or the trading hours that we have in that market. So when we talk about the trading market, trading continue, or in the forex market, forex trading continue 24 hours. But depending on the broker can choose to trade the time that he or she likes. So we have 24 days, that's 24/7. That's 24 hours in 7 days in the synthetic market, which is the volatilities. But in the forex market, it's open for 24 hours, but 5 days, which is from Monday to Friday. Now we have various time sessions that market open. We have the London market, we have the New York market, we have the Tokyo, among others, depending on which time frame you are doing. So the diagram on your screen is actually showing the various time frame. So when you look at from 5 a.m. or simply from 7 a.m. to about 3 p.m., you have the London market. Then from 12 o'clock, which is simultaneously moving with the London, from 12 o'clock to about 8 p.m., we have the New York. We have the Tokyo moving from 11 p.m. down to 4 a.m. the next day. So they interchange, or there are lagging between the opening of the sessions. And the interesting thing is that whenever the sessions are about to change, there are drastic movement in the market. It for you to be able to get what goes into the market, and trading in those changing market disturb the market. So it is always good to understand the forex market, and in understanding the forex market, you must know your averages, you must know the daily trend or the trading volumes that you need to take into consideration. Now the forex market as it stand now have gotten in the market an average daily trading volume of 5 trillion US dollars. So which means that there is, like, the market is liquefied with an amount of 5 trillion US dollars. So which means within that you will be able to make your home money. But as you are losing, somebody is winning, and as you are winning, somebody is also losing. But still, the market is in liquidity of what, 5 trillion US dollars. That's a good news. So depending on your strategy and what you take into consideration, you will be able to make money and enjoy yourself. That's the most important. Now, there are so many things that we need to understand in the market. So one, there is no central marketplace. That there's no any physical place that you go and say that you are going to trade, or yes, you are going to exchange your market. Then trading is conducted over the counter. It's conducted over the counter, which means that it could be where there is a central place with all other process. Like when you go to SEC, those in Ghana, the Security Exchange Commission, no, there is nothing like that. Then forex is just a product quoted by all the major banks, and not all banks will have the exact same prices, like the way it happens in the bank. So when it comes to the brokers also have their own adjustment as to how price move. Now, so when we talk about forex trading, all things come to mind when we say forex trading. All that we did first was based on understanding the forex. But now when we talk about forex trading, what comes to mind? So simply when we talk about forex trading, it's just you one speculating on the price of currency against another. So when you come, for example, if you think that the euro is going to rise against the USD, you can either buy the euro USD currency pair, because we have the euro as the base currency and the USD as the quoted. Now you know that there will be a rise in euro against the USD. So what you must do is that you must rather buy the one that is the base currency, which is the euro, because you know that that's the one that, if the vice versa or the opposite, if you think the dollar will rise against the euro, then you need to sell euro USD, so that when the euro is weakened, the sell will happen. So that's where we have the buy and sell. So at every point in time, market is buying and market is selling. Depending on which position you are, you make the money. If you are against it, then you are losing. But when you are with the trend, that means you are making it. Now, exchange rate. So when we talk about exchange rate, it's just the value of one currency expressed in terms of another. So as we said, euro USD. So when we talk about euro USD, that means the euro is the base currency and the quoted one is the USD. So they can tell you that the exchange rate is 1.3. So which means that when you pick 1 euro, you are going to use $1.3 to be able to get one of the euros. So that's how it makes, as we are been doing it over and over. Or when you go to the forex bureau, the same thing that they do is not far different from it. So as shown on the diagram, you can see, so 1 euro is worth 1.32 USD. I hope we are getting something out of this. Don't worry, you can make your comments known at the comment box and we'll attend to you either privately or even general. If not so, we'll bring all answers in our next training. So now when we talk about pips, you know, a lot of people when they are trading, they always make the information, hey, pips here, we are going to make pips today. And a lot of people get confused what pips is. So when we talk about pip, it's just the smallest increment in price movement of a currency in the market. So for instance, when the market price of euro USD is 1.105 and within a second it moved to 1.1051, then the 0.0001 equal to 1 pip. It means that's the change, that's the smallest increment or decrease in what the currency pairs. So it's based on this that we calculate the pips value. So when you multiply the pips value by the number of pips that you've gotten, then you will be able to calculate your profit for every trade that you pick. So either buying or selling, you can make a pip. And a pip can be either positive or negative. Negative, it means that you are against the trend, you are buying and the market is selling. So this time, the pip that you are getting is a negative pip. So it will give you a loss. But when you are in a trend where you are buying and market is buying, you get a positive pip and you move on. Now, like banks or other financial institutions takes into consideration, we have leverages, and for every bank to operate, there is a good for, like it is good for the bank to have good leverage, which means that the liquidity and the expansion of the bank is intact, that it will be able to receive deposit and also pay monies back to what its customers. So the same thing when we come to trading, we have leverage, but in this sense the leverage is basically the ability to gear your account into a position greater than your total account margin. So some brokers allow for a minimum of $10. Now the leverage have helped you that your $10 could be in a equivalent to what, $10,000. So in your margin or your account will be able to sustain a trade where your margin will increase to what, 10,000, depending on the leverage that you pick. So we can have leverage as 100:1, 500:1, 1,000:1, which means that every $1. So if you take a leverage of 100:1, it means every $1 is $100. So every $1 that you deposit into your account is $100. So if you deposit $10 and you choose 100:1, it means automatically your account is on a leverage is on a margin of 10,000. So it will allow you to take some lot size that you will be able to trade. The same thing when you take 100:1, 1,000:1, then it means that you multiply the 1,000 by the $10 that you have actually. Your margin will increase to 10,000. So with that one, you'll be able to trade, or you will be able to hold a lot of position based like more than the one who chose 100:1. So the leverage just helps you to be able to get more open position, which in actual sense your $10 could not even hold. So that's the purpose. So the higher your leverages, the minimal your returns and the minimal your losses, which means that you, if you want to lose to, you lose at a minimal rate. When you are like earning to, it will be at a slower pace. So it determines the piece value as well, and it helps with the lot size. So the lot size that you use will also determine the piece value that is needed. So those are some of the terms that we have in the forex market. I just talk about the lot size. So the lot size also help us to be able to take a trade, and depending on the return that you want and the risk level you want, you pick a lot size. So we have in some of the brokers the lowest lot size could be 0.001. So in this case it means every pip will be like 1 cent. So until you get $1, then you must be able to get 100 pips. The same thing when you choose 0.01, maybe the pip value now is 10 cents. So to be able to get $1, then you have to get 10 pips, then multiply by the 10 cents, you have 100 cents, then equal to what, $1. If you have one lot size, depending on a broker, it could be like $10. So every movement, every pip is $10. So when you lose 10 pips, it means you are losing $100. If you win 10 pips, you are winning $100. So the lot size also determine the risks involved with your trade or your open positions, and the return or the loss expected. So that's the lot size. As we move on in other this thing, we will get more into it, and when we come to the practical aspect of it, we will see how all those things works. So when we talk about the currency pairs, I think I've explained it, but when we talk about the currency pairs, it's just simply the exchange rate of two currencies is quoted in a pair. So it could either be a Euro USD, where I said the Euro is the base and the quoted one is the USD, or the USD JPY. That's the US dollar versus the Japan yen. So now in this case, the USD is the base currency and the Japan yen is the quoted one. So it's just like the way we have Ghana cedi to the dollar. So that's how it is. So we have the base currency and the quoted or the code currency. Now, in every businesses or when we talk about auctioning and all those, there are some bid prices and ask prices. The same thing is not different from what we have in our forex market. So in the forex market, we have the bid price, which is simply the bid is the price at which the market or your broker will buy a specific currency from you, as we always do at the bank. Then the ask price is the price at which the market or your broker will sell to you. So, for instance, Ghana, like when you go to Bank of Ghana, as it stands today, when you are buying dollar, you are going to buy at a rate of 13.1. That's Bank of Ghana. But when you go to any other bank, it's around 13.7, 13.9. But when you want to sell to them the same, you are going to sell at 12 Ghana cedis or 12.1, depending on this. So now the difference between the bid and the ask price, it gives them their commission or the profit they also make as brokers or as banks. Yes, as brokers or as banks. So it's not far different from what we've been doing at our local forest bureau. But the only thing is that we have it in like we have a place where you can walk to and you'll be able to have this. But this one is an online platform where the same thing is being exhibited. Now we have two types of trades in the market. So we have the buy and the sell. So you either be buying at a point depending on your analysis, or you'll be selling at a point depending on your analysis. But what happens is that at every point in time, market is either buying or selling. So any that you are able to take depending on your strategy will be what will be happening in the market. And also it will be happening as buy and sell. Some people decide to hedge, so they can be buying at the same time selling. So when market is buying, they are making profit, but they are making loss at a sell, which we call hedging. So you can either execute the two, or you choose to do one depending on what you want. Now, in every market, or when you heard of trading terms, people say, oh, I'm going to short position, I'm going to long position. So we use two animals that to depict what we mean, whether short or long. So when in a forex trading, somebody say, oh, my brother, me, I'm going for a long position on Euro USD. The person is just simply telling you that, oh, he's going to buy Euro USD, meaning he saw his analysis that the euro will be strengthening against the dollar. So he will decide to go for the euro, a long position on Euro USD. So what does it mean when you say you are going for long position? So when we go long, it means we are buying the market, and so we want to make to rise so that we can then sell back or our position at a higher price. So as you are in the market and you are in a long position, a market is buying or increasing, what happens is that as soon as you close the market, then automatically your position have been sold to the market, so you make the profit. The same thing when you are going against the trend, you are shorting or you short into the market or sell and the market is in a buy. What happens is that when you close the loss, it means that's the price at which you pay or you lost to the market. So when you are in a long position, we call it bullish, or if a market will long, we call it bullish. This is derived from the animal bull. We all know the bulls, they pull things from the down to the top. So they bend their bulls down or the horns down and pull things up. So as you can see in the uh, diagram, we have the bull over there. Then the same thing goes with the shorting in the market. So when you short, it means simply you are selling the market, knowing that the market, like some quote, will go below. So when we come to pound USD, you are saying that you are selling pound USD because you say that the pound is going to hurt, lower itself, or it will be weakening against the dollar, or the dollar will be strengthening against the pound. So in this case, you are buying or you are selling the pound USD. So when you look at the animal that we use in the diagram is bear. That's why we have the bearish market and the bullish market. So the bull means longing or buying, and the bear means selling or shorting in the market or short the market. So that's the two terms that we mostly use in the market. So when somebody say, "Oh, today market is going to short," or "market is bearish," then know that it's a sell. So every position that you need to take should be in a sell position. I hope so far we've learned something. Yes, we've learned something. So you can see the diagram that depicts all. The market fight is always the bullish versus the bearish. So some market traders or market players decide that, oh, we are going for the short position or the selling position. Others are also going that they are going for the longing. They'll long for the market or those buy the market. So depending on the market sentiment and the pulling, the strength of the bulls and the bears determine where the market goes. There are sometimes where market wedge. It means the market don't either know whether to sell or buy. It means the positions of both the bulls and the bears are at equilibrium. So you either see market wedging, market shoot up by a number of pips and comes down by the same number of pips. So with that one, it means the market don't know where to move away. In those type of trading, you don't enter into a trade, but what you basically do is to wait for the trade or for the market to get its position. Then you can now follow the market. And the most important thing is to be able to get your market, okay, to be able to get the market trend. If you are able to get the market trend and you are in market in line with the trend, my brother or my sister, you will surely make it. So looking at the chart over here, this is the bullish chart. Now who remember what bullish mean when I say bullish? Yeah, you can make your answer in the comment box and we'll be able to, yeah, I'll give prize to the person who won. So when we talk about the bullish market, it's just simply you are longing or buying the market, or market is buying. So you can see, so the trend showing that the market is in a buy position. Yeah, this one will come to it because it's a whole lot that we need to learn about the chart. Even every movement of the candles, the formation of the candle, the type of candle forms, and all those things all determine. Oh, okay. So when we talk about the chart, a chart you can either use a bar chart, okay, or a candle chart, candlestick formation. And when we talk about candle, it's just a symbol of how price movement is. So when you look at the green candle, it means market have bought, so it's green. But when you see the reddish one, it is market have sell, so it's a bearish candle, and the green one is always the bullish candle. So the bullish candle depict a rise in a price or a rise in the market, and a bearish candle means a fall in the market or a fall in price. So the bulls are at its peak, they are pushing market to the top. Then the next one is the bearish market, where the bears are also dealing. So the market is sloping downwards from the left. Then whilst the bullish, the market is sloping upward from the left to the right. So it's just an economic terms that we mostly use. So if you are able to understand your economic terms, you'll be able to. So we have in economy price ceiling and price floor. In trading, we have resistance and support. So the ceiling, price ceiling is the same thing as the resistance, and the price floor is the same thing as the support. So at every point in time, market either form a resistance or a support, and market always tested or goes to immediate support or immediate resistance. When it bounce back, you need to come back to test whether you will be able to break it to the up or it's going to break it to the down. Depending on your analysis, you will be able to get your money from the market. All too soon, we are coming to the end of the introduction to the forex market. So in forex market, we have two analysis. We have the fundamental analysis and we have the technical analysis. The fundamental analysis, we don't have control over it. They are the various business or financial news that happen each day. So it could be an economic news, the increase in inflation rate, increase in policy rate, depreciation of the currencies, among others. Economic policies that have been put or brought by government to intervene in order to solve their economic issues. All those things form part of the fundamental analysis. So with that one, if you are able to understand the implication of inflation rate or depreciation in the economy, then you will be able to analyze and you will purely trade on fundamental. But the risk behind is that you don't know how market is going to react to that fundamental. But when we come to the technical, technical is based on the previous trend of a market. So it means the markets have already performed so much for over a period. So based on that, you are able to analyze, okay, and you know that, oh, market maybe in 2005, market was able to buy. When it bought to a certain level, it retraces to come and test a support. Do you get it? With the help of a candle formation or the sentiment, the market sentiments, or the volume of a market. It doesn't mean that what repeated in 2005, if similar, it will repeat in what 2023, the same month. No, but based on those movements, you will be able to predict either market is going to do the same or similar, or will do opposite. So these are some of the indicators that help us to be able to analyze. So we have the RSI, which is the relative strength index. We have the MACD. Then we have the stochastics, the volumes. We have the moving averages. We have the Bollinger Bands. We have the multi-time frame analysis. Then we have the price action. We have divergence. We have a lot, but these are some of the few ones that we'll take into consideration. We have the parabolic style, among others that people use. We have the Fibonacci, a lot, Ichimoku, which people use in order to. So what happens is that when you are able to develop a strategy, you always test that your strategy over a period of time and make sure that the strategies are able to give you a 95% result. If so, you can believe and come. And a lot of people, I will leave you with this simple advice. I always say that differences between traders is not how long you trade, but it's how you are able to manage your risks. Yes, you are able to manage your risks. So if you are able to manage your risks and you are not greedy in the market, you will actually make your money. But if you are greedy in the market will also be greedy to you and will move on from that. So on this note, I might say this is the end of our presentation on the introduction of forex trading. So thank you very much. I'll move to the social media platform to see the questions that will be there. Then we'll use some 5 to 10 minutes to be able to answer that. Then we can meet in our next episode for it. Thank you. So do not forget to subscribe to our page. That we have the link in confidence Baku Ajay. You can follow me there. And also when you come to YouTube, it's 5 minutes with confidence. The same link that you are able to join. You can see all our trading history, trading courses and videos over there. And also do not forget to call us when you want more information. You can call us on 0242 368 557. Again, 0242 368 557. You can WhatsApp us or you can reach us to us at any time. Do not forget to subscribe, as well as do not forget to share with others. As you are able to get it or get knowledge from there, is because of somebody who shared to you. That's why you are able to. So you also share with one another so that we can move forward and be financial independent in the future. The goal of Nexus Trading Center is to help or equip the young ones to be able to, at any point in time, generate income. Thank you, thank you. We appreciate your patience, and sorry once again for the technical challenge that we have from the beginning. Going forward, all this will be in place and we will move. Thank you very much. So without any, I can see, as I said, we'll move to the social media side. Any comment or question that is there, we'll answer it or we'll bring it to our next episode. Then also there are few services that we provide. So if you want to subscribe to our monthly signal we have it. You can call the number that I send you, and we'll add you to the subscribers platform. We are also currently engaging in pull it together through for a specific time. Call the number 0242368557 so that we'll talk more on it and give you more details. We also train people at a fee. So if you want to know more, especially the technical aspect of this, you can also reach out to us and we'll be able to do the training. And also watch out for our physical training that will be coming very soon. We will announce the date and the venue. It will just be at a minimal fee, for which you will be equipped with every knowledge that you need to be able to engage in forex trading. Do not forget to contact us. We love you, and here at Nexus Professional, we want to build a unicorn together. Thank you for your patience. Bye bye for now. Still, my name is Confidence AG, the Chief Trader. Bye bye. Bye bye.